The greatest investor was only 19 years old when he read The Intelligent Investor and Guaranteed. This book completely changed the way he saw money. No magical promises or attacks. What Graham teaches is to think about risk and invest with a cool head, staying away from common traps. These are 5 simple rules that guided Buffett to build his fortune, and that you can also apply to protect and multiply your money. The biggest confusion that many people make is to believe that they are investing, when in fact, he is only an investor in the market. Investing is like buying a house to live in. You look at the neighborhood, the structure, think about the future, and the real value of the property. On the other hand, speculating is buying a house just because someone said it was going to explode without looking at the document, the neighbor, or if there is money. A true investor seeks security, a reasonable return, and does the homework. The speculator only wants to be rich quickly. In Brazil, we saw this in the fashion stock craze, and even in cryptos. Many men entered without understanding anything and lost everything. Graham warns, a stock is not a lottery ticket. It's a piece of a real company, with employees, products, and bills to pay. If you wouldn't buy the whole thing, why buy a piece? This mindset prevents burning money. The speculator lives on emotion, fear, and greed. The investor lives on patience, study, and discipline. Speculating is adrenaline, but investing is tranquility. The difference is having wealth in the future or only regret. Those who follow this rule are already ahead of the majority. The speculator lives off hearsay. Buy because a friend said so, because he saw it on Twitter, or because the media said it was a trend. The investor analyzes the balance sheets, understands the sector, and only puts money where there are solid fundamentals and real prospects. Speculation is pure emotion. Investment is reason. The difference is controlling anxiety and thinking long-term. In the dot-com bubble in the 2000s, many people bought companies with no profit just because they had a .com in the name. The same repeats with current trends. Assets inflated by hype, but without foundation. Whoever gets in usually loses, unfortunately. Graham clearly says that quick profit may happen, but it is not investment. That is speculation. And speculation costs dearly in the end. In Brazil, we have seen IPO and crypto crazes that look like easy money. The result? Thousands lost fortunes. The intelligent investor prefers smaller but consistent gains instead of risking on passing waves. Buffett is the proof of this. He avoided speculations and focused on solid businesses, while others drifted toward ruin from euphoria. Understand this. Speculation is immediatism. Investment is patience. Only one of them builds lasting wealth. Speculation is like the lottery. Some win a little, but most lose. It's not strategy, it's luck. The investor studies and waits. The investor looks for solid businesses and ignores newspaper headlines. In the short term, speculation seems fun. In the long term, it only causes stress, anxiety, and loss of wealth. Graham shows that investing is thinking like an owner. Would you buy a piece of a business without knowing what it does? Those who speculate focus on charts and promises. Those who invest care about real profit and sustainability. Buffett avoids trendy stocks. He prefers solid businesses, even if they don't make the headlines, because they always generate profits. The investor doesn't forget that the market is cyclical. The investor remembers that patience overcomes every crisis. Every investment made without study is an unnecessary risk. Every well-thought investment is a step toward freedom. The investor thinks about tomorrow. The investor thinks about the next 10 years. It is this vision that builds wealth. Graham's second rule is clear. Stop speculating and start investing for real. This is the path to solidity. Imagine you own a neighborhood bakery with loyal customers and stable profit. Every day, a neighbor shows up wanting to buy it. One day, he offers $1 million, excited because he believes bakeries are booming. The next day, only $50,000. This crazy neighbor represents a market, unstable, exaggerated, always swinging between euphoria and despair. Most people do exactly what he suggests. Sell low in panic, buy high in enthusiasm. Graham teaches, the market is not there to harm you, but to serve you. You decide when to accept the offer. If the company is good, why sell just because the price has dropped? The real value does not change with the mood of the market. Those who understand this profit from the crisis. When everyone is selling, prices are low. That is the time to buy value. Buffett has always repeated this lesson. He got rich by buying solid companies when the market undervalued them. The secret is not to predict the next move, but to understand value and wait for the right price to act. The market is noisy, but you don't need to dance to its rhythm. Patience turns volatility into profit. The value of a company doesn't change from one day to the next, but the mood of the market does. And that is the real drama. It exaggerates on good news and collapses on bad, creating waves of euphoria and panic that confuse investors. If you follow this mood, you lose money. You buy high in enthusiasm and sell low in fear. The intelligent investor does the opposite. Waits for the crisis, buys low, and holds until the real value appears. In 2020, gigantic companies plummeted without losing quality. Those who believed in value obtained historic returns. Buffett has always said that opportunity appears when the market is in despair, not when everything seems perfect. The secret is to keep calm when everyone else is losing their heads. That's when investors separate from speculators. Mr. Market is not an enemy. He is useful. He shows you different prices every day. You choose when to act. The intelligent investor ignores the noise and focuses on the essentials. If the business remains solid, then the low price is a gift. This vision transforms crises into opportunities and difficulties into open doors for those who know how to wait. Benjamin Graham said, "Never pay the full price for stocks. Always buy at a discount to have a margin of safety. It's like building a bridge. If the trucks weigh 10 tons, you don't build a bridge for 10, you build it for 30. That excess is protection against the unexpected. In the market, that means paying less than the real price of the company. If a company is worth $50 per share, the intelligent investor hopes to acquire it at $30. That's the corridor of protection. Crises prove this rule. In 2008 and 2020, solid companies were undervalued simply because the market was in panic. Buffett appreciated those moments. He didn't know the future. He just bought at a discount. There is a margin of safety because mistakes happen. No one predicts everything, so you need room to make errors. Many fall into the trap of FOMO, buying stocks at high prices. But a good business at a low price is always a good business. Graham teaches, wait, the market always changes its mood. The real value appears for those who have patience. Buffett sums it up well. The market transfers money from the impatient to the patient. That is the margin of safety. Think like a consumer. You don't buy a television without waiting for the promotion. With stocks, the reasoning must be the same. The discount is your protection. The greater the margin, the less fear when prices suddenly drop. Those who buy without a margin panic. Those who buy with a margin see the opportunity to strengthen their position. The margin of safety is not speculation. It is prudence. It is recognizing that no one can always protect themselves from everything. Buffett waited years for ideal prices. This discipline made him a millionaire, while others ran in despair. Even with little money, this rule holds true. Investing with a margin protects any investor, big or small. It is a protection of the intelligent investor, avoiding unnecessary risk and buying stocks on sale. Without a margin, a surprise can wipe out your wealth. With a margin, it becomes the opportunity to earn even more. The greater the discount, the lower the risk. This is the essence of the protection Graham taught Buffett. The margin of safety is patience, discipline, and humility. It is admitting that you can be wrong, so you protect yourself beforehand. Graham said every investor must choose a side, either defensive or arrogant. Staying in the middle is a recipe for loss. The defensive investor is like someone who goes to the gym just to maintain health. He is not too strong, but he builds results with consistency. He invests in broad funds like market indexes and makes regular investments without trying to guess the future. With discipline, this profile uses the power of compound interest and builds wealth slowly, but without major surprises. The arrogant investor is like a competitive athlete. He searches, measures, compares, and dedicates hours to daily training. He analyzes balance sheets, studies sectors, and looks for undervalued stocks. It is hard work, not to be taken lightly. Both paths are valid. The problem comes when someone tries to mix them and gets lost in the middle. The defensive investor does not need much time or deep experience. The arrogant one requires study, discipline, and courage to decide. Buffett started as the arrogant type, looking for opportunities. But the athlete admitted that the majority should follow the defensive path. The most important thing is clarity. Choose your side, stay firm on it, and don't get carried away by improvisation. Graham taught that it is not intelligence that separates winners from losers, but emotional control. The market rises and falls without apparent logic. What decides your result is how you react to these fluctuations. Fear makes you sell at a low price. Greed makes you buy at a high price. These two emotions destroy entire fortunes. Buffett summed it up. Be fearful when others are greedy and greedy when others are fearful. In crisis, many sell while running. The disciplined buy at an attractive price and enjoy the fruits when the panic passes. In euphoria, crowds rush to get in. The disciplined wait. He knows it is not wise to pay any price. Without discipline, no strategy works. You give up everything at the wrong time and suffer irreversible damage. The solution is to have a system, regular contributions, diversification, rebalancing. This replaces emotion with a method. It's like a pilot in turbulence. He does not give in to panic. He follows the instruments and keeps the course steady. Discipline is the glue that holds all the other rules together. Without it, even the best plan collapses at the first obstacle.